So following our recent look at Coda Octopus Group, today we're pivoting to a name that really almost perfectly captures the high-risk, high-reward dynamic in aerospace and defense, Satellogic.
Satellogic is, it's a fascinating case study. You've got this vertically integrated geospatial company aiming for a big, scalable, fully automated Earth observation platform. I mean, the ambition is huge, but the financials, well, they show that classic severe structural challenge you see with these very capital-intensive space ventures.
And that's precisely it. That's the core of our disagreement today. Does the company's, frankly, exceptional commercial momentum and its strategic execution, does that fundamentally justify the, let's be honest, severe financial inefficiency and these, astronomical valuation metrics? My view is yes. The strategic vision, the explosive revenue growth, they provide the needed cover for the short-term burn and really validate the long-term story.
And I'll be taking the opposing view. For me, the extreme unprofitability, combined with a really quite profound, very visible lack of insider confidence, well, that signals significant operational problems and, frankly, an unacceptable level of investment risk. We need to look past the flashy customer wins and really stare at the balance sheet reality.
Okay, so my position is this. Satellogic is showing the kind of compelling commercial execution that's absolutely necessary to achieve, let's call it escape velocity in this high-growth space. We're not talking static numbers here. This is exponential traction. I mean, look at the sales QQ surge, 105.75%. That's remarkable. And this growth, it's validated by genuinely huge strategic deals, not just minor wins. You've got a $30 million contract for AI-first constellation services announced back in April 25. Then there's an exclusive 7-figure deal with Suhora in India from just last month, September 25. This isn't just random sales activity. It's deliberate strategic positioning. Then you layer on top these really crucial corporate moves, like finalizing the shift to U.S. jurisdiction in March 25 that strengthens their market position, and then getting included in the Russell 3000 index. The market sees this, right? The stock's up over 240% in the last year. That signals real external confidence. Even with, high multiples, like a price to sales of nearly 29.
But I approach it from a fundamentally different angle, grounded in operational efficiency, or really the lack thereof. My thesis is simple. The staggering operational losses and the sheer amount of capital required are structural flaws. They expose investors to, frankly, unquantifiable risk, no matter how many customer wins they announce. This company seems trapped in what I'd call the CAPEX trap. It's almost endemic to these vertically integrated space players. I mean, just look at the efficiency metrics. Gross margin, negative 37%. But the real horror show is the operating margin, negative 509%. A net loss over $116 million. That points to a fundamental inability to deliver their core service profitably. And what's more, their balance sheet suggests they're actually shrinking the underlying equity value. Book value per share is negative 65 cents. Think about that. If they liquidated everything today, shareholders would still be owed money. And liquidity is, it's precarious. The quick ratio, the current ratio, both hovering right around 0.98. That means their most liquid assets barely cover their immediate short-term debts. That raises serious near-term solvency questions for me.
That's an interesting point on liquidity, though. I would argue the valuation needs to be framed differently considering the technical moat here. That yes, astronomical price-to-sales ratio of 28.79. It's justified partly by that explosive sales QQ growth, but also by the fact that we're pricing the value of the proprietary data generated by their constellation, not just past profits. Aerospace and defense contracts, they inherently require massive upfront investment. The capital to design, build, launch the satellites. It's the very definition of a front-loaded capital curve. And the validation from partnerships with giants like Palantir Technologies and Maxar Intelligence. That's critical. It signals that Satellogic's imagery and data architecture are becoming essential pieces of the defense community's digital infrastructure. You pay a premium for that kind of technological scarcity.
I'm sorry, but I just find that reasoning hard to accept when the fundamental cost structure appears so broken. Growth, yes, but growth achieved at this cost. It looks more like capital destruction just dressed up as expansion. You mentioned the PS of nearly 29. Okay, let me counter that with the company's profit margin. Negative 903%. For every dollar of sales, the company loses nearly $10 on the bottom line. That isn't just temporary investment pain. That feels like a deep, structural inefficiency. And look at return on invested capital. Absolutely critical for a CAPEX-heavy business like this. It's negative 330%. We need some proof, some evidence that these admittedly impressive customer wins are actually leading towards, or at least offer a visible path to, positive gross margins. Otherwise, you're just funding growth for growth's sake, right? Accelerating the cash burn while digging deeper into that CAPEX trap I mentioned. Let's pivot slightly. Let's move from the income statement reality to the signals being sent by management themselves. Specifically, this pattern of insider transactions. The sheer weight of the sustained selling here is, well, it's inescapable. It raises serious questions about whether leadership truly believes they can close this efficiency gap. You have the CEO, Emiliana Kargieman, the CFO, Rick Dunn, and their major affiliate, Hanover Holdings SA. They are consistently selling shares throughout 2025. And often it's right after exercising options. The people with the clearest inside view of the actual future trajectory are systematically reducing their personal financial stake. If the path to profitability was really as clear as you suggest, why would we see this consistent, systematic reduction in exposure?
Yes, insider sales are happening, but they are often linked to these option exercises. It's a pretty common way for executives to unlock wealth that's tied up in stock options. But let me pose a sort of Socratic challenge here. If management genuinely thought the company was fundamentally broken, that profitability was simply unattainable, why would they still hold such a massive stake? Overall, insider ownership is still very high, over 50%. And importantly, the market has counterbalanced these sales with clear external institutional belief. Satellogic closed a $20 million registered direct offering in April 25. And remember the $30 million strategic investment from Tether back in April 24? These external capital injections show that sophisticated institutional money believes in the long-term vision enough to put tens of millions down. That acts as a pretty powerful validation against those internal sales, wouldn't you say? Let's circle back, though, to commercial viability, the strength of the customer base, because that's ultimately the justification for a high-growth valuation like this. The focus on government and defense is absolutely critical here. Why? Because these contracts tend to be long duration, potentially higher margin, and very sticky once you're in. Getting into NASA's commercial small-sat data acquisition program, the contract with the Brazilian Air Force, these are major validation milestones. And crucially, that move to U.S. jurisdiction, it strengthens their access to these critical markets. It's clearly an intentional strategy to compete more effectively for those high-value national security missions. We see evidence of that with the expanded partnership with HEO for space domain awareness. This strategic domestication isn't just paperwork. It's a necessary step to secure the kind of multi-decade revenue streams needed to eventually fund the constellation's operational leverage.
But have you really considered the immediate geographic dependence that this move might be trying to paper over? While bringing the company legally to the U.S. is a positive strategic step aimed at future government revenue, the source material is quite clear. The company currently derives maximum revenue from Asia Pacific. Now that concentration introduces significant geopolitical risks, doesn't it? Especially when you're simultaneously trying to win sensitive U.S. defense contracts that demand, intense supply chain security and minimal foreign influence. The risk here is that you end up alienating your current main revenue source while potentially failing to penetrate the, let's face it, highly bureaucratic U.S. defense market fast enough to offset that massive ongoing capital burn. And we just have to keep coming back to the financials. You highlight the NASA contracts. The material mentions one for about $1.6 million back in September 24. Okay, that's a great validation point, but contracts like that haven't solved the immediate liquidity problem. That tight current ratio of 0.98 is a clear blinking signal. Strategic validation is yes necessary, but solvency is absolutely essential. We're talking about a company valued based on presumed future technological dominance, yet it's facing these very real near-term liquidity pressures caused by operating margins that are, just think about it, over 5 times negative.
Look, the tightness in the current ratio, I'd argue, reflects the rapid scaling strategy itself. But the contracts, the big ones, they validate the long-term annuity potential of the business model. What we're seeing is a high beta growth company operating in a deeply capital-intensive industry, and it's executing a critical phase of its commercial strategy. The operational achievements, landing high-value, sticky deals like that $30 million AI services contract, accelerating revenue over 100% quarter over quarter, positioning strategically with the U.S. move and Russell 3000 inclusion, these are the metrics that matter most right now. These wins established a technical moat in the market position needed to eventually achieve operational leverage. And that justifies the extreme, yes, but speculative valuation.
So, to sum up my position, a business model generating negative operating margins over 500%, coupled with persistent, verifiable insider selling and a negative book value per share. Fundamentally, that represents severe, potentially catastrophic financial risk. The success in winning government contracts is important, I grant you that, but currently it appears non-accretive. It needs to translate rapidly and definitively into vastly improved gross margins and actual positive cash flow to justify its current enterprise value. Until management demonstrates they can actually escape this CAPEX trap by achieving positive efficiency and delivering their service, the risk, in my view, remains fundamentally disproportionate to the potential reward.